In this video, we will deal with the accounting treatment of Workmen Compensation Reserve and Investment Fluctuation Fund. We are studying 12th class accountancy's chapter 4. Name of the chapter is Change in Profit Sharing Ratio among Existing Partners. In this chapter, we have already discussed the gaining ratio, sacrificing ratio calculation, valuation and accounting treatment of goodwill, and in the previous video we discussed about the distribution of reserves and accumulated profit. Here we will continue that topic and we will discuss about the accounting treatment of Workmen Compensation Reserve and Investment Fluctuation Reserve. Now, what do we mean by Workmen Compensation Reserve? Workman Compensation Reserve is created out of the firm's profit. Okay, it is created out of firm's profit to pay compensation to employees. So from the profits, a reserve is created. So reserves belong to the old partners in old ratio. So at the time of reconstitution, it will be divided among the partners after the adjustment of the claim against the Workman Compensation Reserve. At the time of change in profit sharing ratio, it is treated as follows. There are various cases like the claim against the Workman Compensation Reserve is more than the reserve, it is less than the reserve, or there is no claim. So we will be discussing those cases one by one. First case, if there is no claim against Workman Compensation Reserve. Now there is no claim, that means the full amount which is there in the Workman Compensation Reserve will be distributed among the old partners in old profit sharing ratio. Okay, see, at the time of reconstitution, all the accumulated profits and reserves will be divided among the old partners in old ratio, so that no one stands at profit or loss. We will understand this particular point taking one illustration. There are two partners A and B who were sharing profits in the ratio of 3:2, have decided to share profits in the ratio of 4:3 in future. Now their balance sheet is given, and the question says that there is no other information. That means there is no other information regarding the claim against the Workman Compensation Reserve. So we will assume that there is no claim. So whatever profit or amount is there in the Workman Compensation Reserve will be distributed among the old partners in old ratio. So the solution will be Workman Compensation account debit to A's capital account 48,000 in the ratio of 3:2, and to B's capital 32,000. Okay, 80,000 is divided in the ratio of 3:2. Since there is no claim, the full 80,000 will be divided among the partners in the old ratio. Now the second case, if the claim is less than the amount of Workman Compensation Reserve, so whatever claim is there, it will be transferred to the newly created account which is underlined here, provision for Workman Compensation claim, and the balance will be transferred to the partners capital account in the old profit sharing ratio. A and B are sharing profits in the ratio of 3:2, and they decide to share the profits in the ratio for the same question, but here the claim against the Workman Compensation is 36,000 rupees. Okay, same balance sheet, 80,000 Workman Compensation Reserve, but here in this case there is a claim. Okay, so Workman Compensation Reserve account debit 80,000 to provision for Workman Compensation claim. This will be credited 36,000, and the balance 44,000 will be divided among A and B in the ratio of 3:2, which comes to 26,400 and 17,600 rupees. See here, I have done all the calculations before typing that, so you may find that I am not taking time, but all this calculation takes time. Practice a lot so that you are able to reduce your calculation time and all. You are able to attempt more and more questions in the board. In case 3, if the claim is equal to the workman compensation reserve, then no excess amount is left. So whatever total amount is there in workman compensation reserve will be transferred to the newly created account provision for workman compensation claim. Okay. So let's take the illustration. A and B are sharing profits in the ratio of 3:2. Okay. In future they are deciding to change the profit sharing ratio, and the claim against workman compensation is 80,000, and in the balance sheet also workman compensation reserve is appearing at 80,000. So no excess amount is there. So the full amount from workman compensation reserve will be transferred to provision for workman compensation claim, 80,000. This claim will appear in the new balance sheet on the liability side. New case, if the compensation is more, now this is little different. Okay, the claim is more than the available funds. Okay, so in that case, whatever workman compensation reserve is there, it will be transferred to the provision for workman compensation, and the excess claim will be debited to revaluation account. Okay, so revaluation account's loss will be transferred to partners capital account in the old ratio. Similar question, but the claim is 90,000 and the amount available in workman compensation reserve is 80,000 only. So workman compensation reserve account debit 80,000, to revaluation account 10,000. Revaluation account is also debited, workman compensation reserve is also debited, and to provision for workman compensation claim, which is credited, amount is 90,000. So revaluation accounts loss will be transferred to A's capital and B's capital in the ratio of 3:2. So 10,000 divided in the ratio of 3:2, A will be debited by 6,000, B will be debited by 4,000, and revaluation account will be credited. Now the new reserve, investment fluctuation reserve, is created also out of the firm's profit against any fall in the market value of investments. Now see, if there is any changes in the market value, and if there is loss, it will be first written off against the investment fluctuation fund, and then only it will be transferred to the revaluation account. Okay, now let's take one case when the book value and the market value is same. That means there is no loss. So whatever amount is there in investment fluctuation reserve will be transferred to the partners capital account in the old ratio. Let's take one question. P and Q were sharing profits in the ratio of 2:1, and in future they decide to share in the ratio of 3:2. The balance sheet says that investments cost price was 4 lakh rupees and there is a balance of 30,000 in the investment fluctuation reserve. So there is no loss. So this 30,000 will be transferred to the partners capital in the old ratio. So investment fluctuation reserve account debit 30,000, to P's capital 20,000, and to Q's capital 10,000 rupees. Okay. Case 2, when market value is less than the book value. Okay, but the value is less than investment fluctuation reserve. So whatever loss is there, first it will be written off from investment fluctuation reserve, and the excess amount left will be transferred to the partners capital account. See, there are two partners, 3:2 is the old ratio, new ratio is 2:1. Balance sheet is same, investments appearing at 4 lakh rupees cost price, and fund investment fluctuation reserve showed 30,000. Market value is 3,80,000, that means a loss of 20,000. So from investment fluctuation reserve balance 30,000, 20,000 will be credited to investment account. Any asset account, when it is credited, its value decreases, and the balance 10,000 will be divided among P and Q in the ratio of 3:2. So P's capital account to Q's capital account 6,000 and 4,000. The balance 10,000 is divided in the ratio of 3:2. When market value is less than the book value. fall is more than the investment fluctuation reserve, then it means the excess amount will be shown in the revaluation account, the loss. Okay, excess loss will be debited to revaluation account. Same question, P and Q sharing profits in the ratio of 3:2. In future they are going to divide it in the ratio of 2:1. Balance sheet showed that investments appeared at 4 lakh, was acquired at 4 lakh rupees, and the fund reserve, investment fluctuation reserve, showed a balance of 30,000, and the market value is 3,60,000. That means a loss of 40,000, and in the fund only 30,000 is left, so 10,000 excess loss is there. So investment fluctuation reserve 30,000, revaluation account debit 10,000 to investments. To reduce the value of investments, we will credit it, so 40,000. So now see, there is a loss of 10,000. So P's capital account debit, Q's capital account debit to revaluation 10,000 in the ratio of 3:2. Now the fourth case, market value is more than the book value. That means there is a profit. So whatever reserve is there, that will be divided among the partners. Investment fluctuation reserve 30,000 to P's capital to Q's capital, in the ratio of 3:2. That is 18,000 and 12,000. Now we have to increase the value of investment, so it will be debited. Second journal entry, investment account debit to revaluation account 20,000. Revaluation is credited because there is a gain. Now in the third entry, the gain recorded in the revaluation account will be divided among the old partners in old ratio. So revaluation account debit to P's capital to Q's capital in the ratio of 3:2. That is 12,000 and 8,000.